Hey there, welcome to the closing bell. I'm actually recording this on the Thursday. I've got a busy Friday lined up on the 15th of August. So I may miss a bit of what goes on in the markets. But today I want to have a look at where we're at with interest rates and whether you should be searching for some dividend payers as we move forward. Because, things have bounced back after that really volatile week last week. I don't think that means it's all over. There certainly can still be more volatility ahead. But I'll show you just on the weekly charts in the S&P, for example, actually possibly at the end of this week, we'll send a little weekly buy signal saying that, that we could see more upside in the short term. And I think the idea for me is that the reason we saw that volatility last week was the bad data in the US, which was saying that the economy may be slowing quicker than people expect. That caused interest rates to drop with expectations the Fed will need to lower rates more rapidly than people expect. That's what created the convergence between Japanese and US interest rates, which forced the unwinding of those carry trades and caused a bit of a panic for the moment. But in the background is that idea that, and sorry if you hear some coughing in the background, that's my son at home with a flu. The poor guy, he's had it for a week. That's a pretty bad one going around, that influenza A. But looking at, the data that came out, the US economy possibly slowing down rapidly. And the reason why you didn't see a big rally after the CPI figure in the US, which was a good figure, thinking that, inflation heading back under 3%, you would have expected a really big rally, but stocks sort of shrugged their shoulders. They're waiting to see a bit more data on how quickly the economy is slowing. And I've told you about the monthly buy pivot in the US bonds, that has actually been set off now. So I thought I'd show you the big picture in the bond markets, that we're maybe on the verge of rates dropping, and sometimes it can be quite rapid once it gets going. So there's opportunities out there in some dividend payers. I've been going into a few in my service retirement trader. And if you do want to learn a bit about how I go about things, I've put together a document for you called The Lessons. It's really lessons of over my, nearly 30-year career in trading, how I go about things and make money for people. So please, check that out. That will be in the top right-hand corner of your video. Press on the little I. If you see that there, you can press on that. That'll take you to some documents. Click on the lessons there. I think they're all the same, really. And you can have a read through and learn quite a bit about my trading style. So, or below the video, I'm sure you'll be able to find a link to the lessons as well. So just check that out when you've got some time. But let's jump to the charts, and I'll even throw out, a name for you just to not as a trade, but as an idea of what's actually out there. Something yielding, 9% grossed up, a pretty good retail stock. So let's have a look at the charts. So I'm going to race through these charts. I don't want to, take up too much of your time. I want to really whip through it so that we can be over and done with in sort of 10, 15 minutes, hopefully. So this is the S&P 500. And I just wanted to give you that sense of the volatility that we've seen, but in relation to, sorry, that was a mistake, in relation to the weekly charts. And the idea being that we've just seen, here's the high in the S&P 500 on the weekly. This was the big sell-off we've seen. That was the terrible week last week. And now we're bouncing back. And I just want to give you that sense that I was saying last week, things are still trending up, and there was a bit of damage done, but not much. And based on the weekly chart, you can see on my trends, that 10-week exponential versus the 20-week simple, that still in weekly uptrend. So that hasn't even been put under threat by the volatility that we saw. And usually when you do get mean reversion events within these weekly trends, and then you see, the buy pivot, the weekly buy pivot, that sort of thing, as we've seen here long ago, that can often be the beginning of the next leg up. So it's often actually a buy signal. While you're in that weekly uptrend, you're waiting for mean reversion events, back to those moving averages. And then here we go. There's a weekly buy pivot there. And off for the next wave higher. There's another one here. Sells off, scares a few people, turns back up, buy pivot, and then we had another few months of rallying before things fell over. So just from that point of view, looking at this S&P 500, you can see even here, we had a little bit of a sell-off there, back to the moving averages, weekly buy pivot, and next leg in the uptrend. So if prices hold up around where they are on the Thursday, that's actually a nice little buy signal there for the short term for the market. So, from that point of view, things may actually start heading higher. But if bad data comes out of the US, that's what you've got to be worried about, I guess. But, all you can do is trust the charts and say, look, at the moment, it's not saying it's terrible. And if we also look at the rally from the low of the correction a few years ago, and just have a quick look at that, you'll quickly see that this whole structure is what? A quite clear uptrend with higher highs, higher lows, and you can see there. And that's why if I'm looking at that wave structure, I'm looking at the most recent wave and saying, right, well, where do you expect to see support in those sort of waves? I look at that range, don't I? And you can see there, yet again, we have a bounce out of the buy zone of that wave. So the thing that will possibly be the point where it could turn back down from is that sell zone of that wave. So if things really are changing, this buy signal may be a dummy. And if it then turns back down and we get a big sell signal there, that's when you start saying, okay, well, watch out. We may be in the early stages of a downtrend. So that's what would need to happen. Certainly not now. For the moment, I would remain bullish letting this happen because this is trending so strongly. There's no reason why it's not going to do that and just keep going higher for the moment before it meets the selling pressure. And also, of course, the weekly trend would need to shift. So early days and, not that much damage done and now possibly a weekly buy signal. So if we just look at those opportunities and think, well, maybe I don't want to load up too much, but possibly buying some good yield plays might be worthwhile because they'll rally with a rallying stock market. But also if yields drop rapidly, they may rally as well. So let's have a look at the US 10s quickly. So this is the US 10-year bond yield chart. And obviously, as yield goes up, the price of those bonds goes down. So yield going down, price of those bonds is going up. So that's the only weird thing about this chart that you've got to get your head around. So over the last few years, of course, up from nearly zero on those 10-year bonds, massive run higher, chasing down inflation, hit 5%. And it's been trying to work out whether that was it. Start of the year, we had an inflation scare. You can see there, rates rising again. And I've been saying to you on the monthly basis, if we saw a monthly close below that 4.2% area, that would be a potential start of a sort of starting gun for rates to then keep falling. Because you can see from that high, what I'm thinking about is here's your first wave lower, up into the sell zone there, and this could potentially be that next one down as we start the process of yields hitting lower. And you can see also the 10-month exponential very close to that 20-month simple. So that long-term trend close to shifting as well. And you'll note, as soon as we got that signal, really rates dropped very rapidly, didn't they? That was on the back of the weak data. So we're on the edge of weak data saying, watch out, things may be slowing down more rapidly than expected. Rates have been high for quite a while, so that's certainly doing some damage out there. We know that retail struggling. We know in Australia no one can afford anything apart from paying for their gas bill. So we could be in for some weak data. Unemployment certainly picking up in the States. So if we look at the past and just look at that monthly trend, when it does shift, have a look at how rapidly those rates can come off. And look, the stock market is sometimes selling off at the same time if things are really bad. That's what can happen. But then that feeds into the next bull market, of course. So you're still saying, I don't know whether this is going to spark a huge rally in stocks if things really do get bad and we see rates dropping very rapidly. But your defensive plays and your high yield stuff may actually hold up pretty well. So it's sort of on the edge. We've got that signal that I've been waiting for a while. And we're certainly seeing follow through with those rates falling rapidly. They can still thrash around, of course, but once we get that signal, the monthly trend changing based on the moving averages as well, just higher probability that things could, despite the fact they might stuff around for a bit, could have some quick moves down. And that could hurt that carry trade, as you know, rates dropping much faster than expected. So that is just something in the back of your mind that you've got to be thinking, well, how can I take advantage of this? What's the smartest play going forward for me? Possibly picking up some yield around. And I have already picked up some, but I was going to just show you quickly one, and this is not a trade. I just want to show you what's out there. So super retail group, you can see here it's performing pretty well compared to most things out there, isn't it? It's on highs, all-time highs, and looking like it wants to keep trading higher. It's in long-term uptrend as well. So it is, testing the bounds here. And this super retail, they own Rebel Sport, boating, camping, fishing, the super retail, the super auto. So they have a number of those retail. They're all struggling. They're not really flying higher, revenue not flying higher. But you may be surprised to know that they give a fully franked 6% yield, which grosses up to about 9%. So, let's say rates start dropping, retail comes back, comes good again. They're already keeping revenue holding in there during pretty tough times. Maybe things get going again. People decide to go camping instead of overseas. Maybe things go well. But they're looking pretty good technically. And who knows, if rates really start dropping, that 9% is going to look pretty tempting. And that could be what drives it higher. But, that's the sort of thing that is out there. And I'm not saying buy it now. I'm not giving you any levels, any of that sort of thing. I'm just pointing out that there are some of these things out there if you go hunting. And if your mind is set on, well, I just want to pick up some pretty good, steady yield. These guys, revenue, pretty steady. You know what's coming pretty well. Pretty solid valuation, trading on 15 times or so. Pretty steady dividend payer. You're not taking on much risk. Maybe you're not going to make heaps and heaps, but nothing wrong with planting something and getting 9% grossed up yield, especially if rates drop rapidly in future. So that's just the sort of thing I wanted to point out today. There are opportunities, possible buy signal in the US actually for the short term on a weekly basis. But, bigger picture, in the back of your mind, you're saying, well, there could be more volatility ahead. All right, that's it. I'll come back with more next week.